Hi back everyone. Welcome to this lesson. As I promised in the previous lesson, we were supposed to talk about the boundaries and tensions or whatever name you want to call it. We could have static kind of boundaries. We could have dynamic kinds of that. Both of them are important for us. So we're not going to ignore one and just give more relevance to another one. So as you remember in the previous lesson that we had just these live kind of trades based on our simple trading idea that as you saw, the critical point that we need to just master is how to define our tension and liquidity points. So here we're just working on first tension, and later we're working on liquidity points inside this actually candles that where they form, and also these tension areas are external liquidity points. So let's start with this one. So to define our liquidity point, external liquidity point that we call in the actually classic price action, they call it support and resistance. And they say that if we have more touch, it has more validity. Actually, the opposite is true. The more touch we have, the weaker it gets. So here we have some ups and rallies. So the last position of the price in this bearish candle. So we are going to find the recent swing that we have. This is the recent swing we have, and before that one. So we will have two last swings that we have, and the maximum bounce of the price is here, and maximum bounce of the price to the lower part is this one. So if we want to define this, the tensions areas and liquidity areas here, we gotta just use these maximum points. So here from the end point of the wick or high, we will extend and we will draw attention till the close of the candle. So usually the ones that they are overlapping, okay, like this tension here, okay. So this is very important. If you just do it otherwise, you're going to get confused and you will have different kind of roadmap, and it's going to just make you just decide differently. Now, the same idea here from the maximum point to the close of the candle, the first close of the candle. It doesn't matter if this one, or this one, because this is the closer. So we're going to draw this tension here. As you see, this bouncing area is so tight. So if you want to just decide other a little bit larger trading range, we will have this swing, which is third swing, and this one, which is our fourth one. And we have one rule. So unless the price has overrun this tension two times, means once it goes up and another time it goes back, or if it goes down, or another time it goes up. So these tension areas are valid for us. So if, for example, here we had a tension area, the price has just crossed it once. So this tension area is still valid for us because we have some remaining buyers or sellers that they didn't, the ITs didn't have enough liquidity to absorb them and make the transaction between these. So that's why we have some. If you have watched my first video, you will remember that how this aggressive and active buyers and sellers, and they are interacting in behind the scene of these candles. So how they just having a lot of liquidities in different points. So now, if we want to define this one now, because we don't have any in front of us, so our next line of defense is this one and that one. Why didn't we choose this one and that one? Because look, if we wanted to just draw a tension here, it has crossed it once and again came back, and there is no liquidity left here. So it means that not only it went up, it also crossed it back. So, but if it was just once and it wasn't just crossing it backwards, okay, so this tension would be valid. But because it hasn't, so this is not valid tension area for us. The next line of defense is here, okay, from down to the body of the candle, and up there from the maximum bounce to the body of the first candle. So if price can overtake this tension area, it could go up there, it could reach almost here, based on the momentum it has and based on the market cycle and time of the market. For example, opening of the New York market, opening of the London market, they have a lot of liquidity when they are taking this tension so strongly. So it is not easy to return back into the area again. So that's why they usually continue their direction. So many people are waiting to have break of the market, opening of the market. And some of them are taking reversal trades. So based on whatever they have learned, and they don't consider momentum or other thing, unfortunately, and because they're not aware of it, so they end up losing trades, although they could get a lot of money out of. So this easy concept. So the interaction between the legs and the tension is our defining point for our direction and the point of entry. So now that we have defined these two, this is so easy to just define based on the tension areas. These are static kind of tension areas. So we know that our liquidity points are a little before these tension areas here. But for now, because our range is just wide enough to just trade, so we're ignoring this to the point exact place of liquidity. So I'm reconsidering this one. And also, if you just go to the lower time frame, these shadow areas, usually they have just point of interest for buyers and sellers. So now, as you remember in the previous session, we said that if it is our higher time frame, this one is our higher time frame. And if we want to just connect the highs of the candles and lows of the candle to form channel, we will do that like this one to get our overbought and oversold area. We could do this one based on our market structure break. It is up to your personal preference. It doesn't matter whatever you are comfortable with. It is almost the same, identical. So now here it continues like that. You see that it becomes a little bit trendier here. And finally, we have the middle line. Overbought area is here. Oversold is here. Now, if we continue this connecting highs and lows of the candles, two candles here, so we will have this again overbought, oversold, and here we have overlapping of the many candles here. So if we were supposed to just connect this one to this one and this one to this one, it is also including these shadows. So this tension and this one is almost overlapping. So this is a small range that we have here. Now, this is the higher time frame. We have identical chart in the next slide, as you see here. Look. I'm going backward and forward between the slide. You will see that. Here we're going to have the average balancing. So here, this average balancing, if I want to just again plot this overbought and oversold areas. So this is the average balancing for this actually trend lines, this channel. Okay, some could consider this one. It depends on people's backtesting, not only backtesting, but also I would just consider this bigger one here, because it is bouncing between these two. And as I said, here also we could use our valid pullback system or breakup structure system to define our overbought, oversold area. So here our overbought area is here. So when the price, let me just do that here, the breakout structure, again, price goes back inside the zone, and especially this upper part of it. So here we are looking for sell signals. It could be close of the candle. It could be, again, reversal of candle, and we will sell. And again, after it breaks here, it gives us another kind of breakup structure and overbought, oversold area. Again, when it goes inside this, it is going again in the overbought, oversold channel. And also here, we're looking for the sell signals. So as far as this, there is no change in the market cycle, and we don't have any tension areas in front of the market, price that makes it reverse or have reaction toward it. So as far as our tension areas are intact and in place. So here, before this move is created, and we have this one, we had this tension area. So and also this one, as you see here, this one, because we said that if we have just once crossing the tension area, so this one also is valid for us. So now, when we have this candle breaking, not only it is invalidating this tension, we're going to hunt this liquidity under this part and under this tension, or sometimes before this tension here. So now let's go and see our overbought here, overbought area. So the price moves down because there is no, what do we call that? There is no line of defense in front of the market, price. So it is easily absorbing whatever it is here. So because the way the price moved in on the left side is a little kind of corrective, and it is easily just absorbing this liquidity there. So it is almost predictable that it is going down to absorb this liquidity under this shadow or wick. And after taking this liquidity here, it is coming up, bouncing up, and it gives us this one is oversold area. So now we could have, if we had here overbought area, we could have flip zone here, but we don't have our flip zone. It's too big here. So that's why we are going to go with the inner about pullback here. Then also this one, this candle is also, you could consider this one, or you could consider this one, no difference, almost overlapping there. And we don't have any proper break below this one. But then here we have also another overbought area in this area that this one, this candle, the candles have taken, and also the candle's low is taken. So and it doesn't matter if you go with this trend line, or you could go with the overbought or sold valid pullback. Both of them are overlapping, and that's why they have confluences. So it depends on your own personal point of view. So here we have the ranging. I put this first chart next to the other one. So this one is a 1 minute chart, and the other one a 15-minute one. So now look at the ranges on both chart while I plot the tensions on that. So the first tension, the first channel that we have here. So now the second one here, the same channel that we had before in the previous slide. Now they go hand in hand in this chart and the other one. So this represents this one, the middle line represent that one. As you see here, we have candle view, but the other one, we have swing view here. So we had this overbought, oversold areas in this one. And also here, this leg represent the other one, and middle this one, and it goes on and on. The same thing there. So now look at the range of them. So we have this small range on this 15-minute candle, and this is the candle base, and this one is channel based here, right? So then we have the swings up and down. Now this range represents this one here, and that one represents this one here, and that one represents this one here. So as you see, you can compare the range of the candles. So they're all the same, but this one we have more details. We have more point of interest, and we have more information where to enter. In fact, the simple trading idea in the previous lesson was based on this candles. Actually, candles close high and low. So now if we want to have the refined version of this candle entry, so we're going to work on the swing areas, liquidity base, because these candles also are kind of indicators, not that liquidity measurements. Okay, so they are the closest indicator for the liquidity behind the scenes. So although you could use the close and high and low of these candles to have a simpler way of making decision, but this one is the accurate way. So then you can use them interchangeably, or you can use them at the same time, and they're going to complement each other. So then here we have this range, so the same range. If you look at this one, we have this bigger range. As you see here, it's a very big range then in the sideway almost. So you could just hunt and this liquidity inside this leg, inside this sideway. And I'm going to show you what happens inside this while we cannot do the same action, the same kind of view on the higher time frame. Look, now that we have this pullback zone, and also here is the overbought zone, or sold actually area of this valid pullback. Now we could wait for the buy setups here, although this one is aggressive because we don't know what happens in the previous part of the left side of the chart. And look at this one, the second one. Now this is our valid pullback. This is our oversold area. Now the same thing here, but we cannot catch this move here if we didn't have this a little bit of refined version of entries again here. So, and now we are looking for sells. Okay, although it is aggressive and it's kind of reverse entry, but here we can have more confidence as entering rather than entering based off candles. So again, another point of entry based on the valid pullback and overbought or sold zone. Another one here as well, while we don't have a strong confidence here to go short in this one because this is just the beginning of the leg. So we're still looking for buy there while we're looking for sell here, although we know that this the probability is a little low and it's high risk area, but if the risk reward worth it, we can just go with that. And also here, the same concept, and it goes on and on. So if I want to just show you the places that it happened, look, this happened in this candle, the other one happened in this candle, the other one happened in this candle, and this one happened in, no, we don't have any exact point of entry, in the candle side, because we're blind what is happening inside this candle bounce. So that's why we consider swing entries better than candle-based high and low and close on open entry. So that was for this session. So for the next session, we're going to talk about the last leg momentum criteria. That momentum is a strong, weak, or the reaction of the leg to the tensions, which is, I think, the critical aspect, which is the king and price action. So stay tuned for the next session. Bye for now.